Coinbase just had its biggest single day rally since the post-election move. 16.5% in one session. On the same day, Wall Street's average price target sits at $302. Almost double from here. And the bull case? It's actually compelling. Deribit acquisition, USDC dominance, the Genius Act, a fortress balance sheet with 11 billion in cash. So this should be a buy, right? Not yet. And today I'm gonna show you exactly why, using institutional volume analysis and what I call the Cantillon flow framework. This is how we do elite research at Cantillon Research. So let's get into it. So before we look at the volume structure, I want to give Coinbase full credit for what they are actually building. Because this isn't a bearish hit piece. The long-term thesis is real. The question is timing. And timing in this framework is everything. So Coinbase, it's the largest regulated crypto exchange in the United States. But CEO Brian Armstrong's vision goes way beyond that. He calls it the everything exchange. Crypto, equities, prediction markets, tokenized assets, all on one platform. First, USDC. It's now the number 2 dollar-backed stablecoin globally with 75 billion in market cap. Stablecoin revenue grew 61% year over year. This is becoming a real financial infrastructure business. Second, Deribit. They acquired the number 1 crypto option platform in August 2025. Combined derivatives volume hit 1.25 trillion in Q4. Derivatives are higher margin, less retail cyclical, and growing faster than spot trading. This is a meaningful diversification. Third, Base. The layer 2 blockchain set transaction record at Q4. And here's the interesting part. They launched Agent Kit, which lets AI agents transact in USDC on Base. If AI-driven commerce scales, Coinbase rails process every transaction. Fourth, regulation is finally turning in their favor. The Genius Act gives stablecoin a legal framework by July 2026. The Clarity Act resolves the SEC-CFTC jurisdictional fight. The regulatory overhang that's been discounting this stock since 2023 is lifting. So why am I not buying? Because all of that is the thesis. And the thesis, no matter how good it is, it's not a regime. Let me show you what the volume is actually saying. This is the institutional volume terminal, my proprietary indicator on TradingView. It reads the volume structure behind price to tell us what institutions are actually doing, not what the headline says. Let me walk you through every reading here. If we look at the dashboard, it says the bias is bearish. The overall regime reads bearish. This is the first thing I look at every morning. Bearish means we are all in a sell rallies environment, not a buy dip environment. That 16% rally the other day in the bearish regime, that's a selling opportunity for institutions, not a buying signal. We have the VWAP deviation. If we look at the daily, we are now almost 43% below the VWAP. Coin is trading 43% below its anchored volume weighted average price. That means price is below the institutional cost basis. On the weekly, it's only 2.9%. That might sound modest, but on the daily, it's 43%. It's actually quite a lot. Coin's AVAP has been resetting lower as the bearish swing matures. The institutional reference point itself is falling. So negative 43% against a falling AVAP is not a very good position to be in. It's not stable at all. It means institutions are still chasing price lower. They are not absorbing at a fixed level and building a base. They are marking it down. So the confluence score is 2. This measures how many institutional factors are lining up. 2 tells us that almost no institutional factors are lining up at the current levels. Some institutional activity, but not enough structural evidence for a regime reversal. We need to see this climb towards 7, 8, 9 before the terminal flags a meaningful shift. And then we have the swing type, it's bear, with a stability 0 out of 2. This is the reading I want you to pay attention to. Stability measures where the volume structure is consolidating into a base. 0 out of 2 means there is no evidence of institutional accumulation at these levels. None. The volume profile has recently restructured. We can see that from the VP recalculations at 1. But it's reflecting the dislocation, not building a floor. 0 stability in a bear swing is the terminal's way of saying the move may not be done. Then we have the volume compression. The volume compression is expanded. This one is really important for understand what comes next. Volume compression tells us where the volatility is contracting into a coil, like a spring loading before the next move. If we look at Bitcoin right now, it reads coiled at 87%. That means Bitcoin is compressing, building energy for a directional resolution. But coin expanded at 50%, it's still in the high volatility aftermath of the sell-off. The spring is not loading yet. No compression. The bearish move hasn't finished consolidating. Until compression enters coil territory, the structure isn't ready for a sustainable reversal. Now here's where it gets really interesting. And this is what separates this analysis from anything else you'll find on YouTube. The Cantillon effect is an economic principle from the 17th century. It says that when new money enters an economy, it doesn't reach everyone at the same time. The people closest to the money source benefits first. Everyone else gets the effect later, often after prices have already moved. I've built this into a trading framework. When central banks improve liquidity conditions through rate cuts, QE, or just softer CPI prints that move expectations, that liquidity flows through the markets into a specific sequence. The IVT dashboard tracks this in real time. Right now it is at accumulation. Liquidity is bullish, that green check. Equities are bearish, that's the red cross, and risk are bearish, a red cross. The macro bonus is +2, which is elevated, meaning the upstream conditions are better than the price action suggests. Now think about where Coinbase sits in this sequence. Coin is a crypto exchange equity. It's a leverage bet on a leveraged asset class. For Coin to stabilize, Bitcoin needs to recover. For Bitcoin to receive flow, equities need to recover. For equities to recover, liquidity needs to keep improving. Coin is 3-layer removed from the liquidity source. The CPI print came in 2.4%, below the 2.5 consensus. That's net positive. It moves rate cut expectations forward. It improves the liquidity outlook. And Coin surged 16.5% in response. That tells you something important. This stock is incredibly sensitive to liquidity shifts. A beta of 3.7 means it amplifies every macro move by nearly 4x. But sensitivity is not the same as regime change. One good CPI doesn't flip the Cantillon sequence. The flow is improving upstream, but it hasn't reached downstream yet. We are in the first inning of a multi-inning process. So let me give you the fundamental context, because this is where it gets nuanced. The headline numbers from Q4 looked rough. Revenue came in at 1.78 billion, missing the 1.85 estimate. EPS was 66 cents against a $1.05 estimate. A 37% miss. and the gap bottom line showed a $667 million net loss. But that loss needs context. $780 million came from unrealized losses on Coinbase's own crypto portfolio. Mark to market, non-cash. The actual business adjusted EBITDA was $560 million positive. That's the 12th consecutive quarter of adjusted EBITDA profitability. Institutions analyzing Coin distinguish between operational performance, which is healthy, and portfolio marking, which is volatile. There's a big difference. So here's what actually interesting underneath. Subscription and service revenue, the recurring less cycle piece, surged 65% to $2.8 billion. That's now 39% of total revenue, up from 22% 2 years ago. Stablecoin revenue alone is $1.3 billion. This business is diversifying in real time. But, and this is the but, transaction revenue still makes 57% of total revenue, and it fell 37% year over year in Q4. Q1 2026 is tracking roughly 10% below consensus. When crypto contracts, Coinbase core revenue engines contract. The diversification is real, but it's not complete. The balance sheet is a fortress. $11.3 billion in cash, $40.1 billion in total USD resources, debt to equity at 0.49. This company can survive an extended crypto winter without existential risk. That's a critical difference from previous cycles. They bought back $1.7 billion in stock in 2025, fully offsetting share dilution, and authorized another $2 billion. Management is buying their own stock and buying Bitcoin with weekly purchases. Though I'll note, CEO Brian Armstrong personally sold out $550 million in shares over the past 9 months. Insiders sell for many reasons, but at that scale, alongside a buyback, it's worth monitoring. Valuation at 14 times trailing earnings and 9.4 times EV to EBITDA. This is the cheapest Coin has been since it became profitable. The 5-year average PE is around 80 times. Wall Street consensus is $302 with a moderate buy rating. Even the bears, Barclays at $226, have targets well above current price. So the fundamental quality is strong, but the fundamental momentum is weak. The valuation is cheap on trailing numbers, but the forward PE of 30 times tells you the street expects earnings to compress further. This is a cyclical business in a cyclical downturn with a structural transformation happening underneath. The convergence assessment. This is where we bring it all together. In the Cantillon Research framework, I look for convergence between what volume structure is saying and what the fundamentals are saying. When they agree, you have a high conviction signal. When they diverge, you need to understand why. For Coin, the convergence is partial. Near-term volume and fundamentals are aligned bearish. The volume structure shows distribution, not accumulation. The fundamentals show declining revenue and soft Q1 guidance. Both agree conditions are soft and the regime hasn't turned. Where they diverge is on the long-term thesis. The fundamentals point to a business building durable infrastructure under a transformative regulatory environment. USDC, Deribit, Base, the Genius Act, these are real competitive advantages with multi-year compounding potential. But the volume structure shows zero evidence that institutions are positioning for the transformation yet. This is the key insight. The market can recognize a good business and still not bid it up. Institutions don't allocate to thesis, they allocate to regime, and the regime hasn't turned. So what would change the assessment? I don't just tell you what the regime is, I tell you what would flip it. 4 things I'm watching. 1. The AVAP. Price needs to close and hold above the volume weighted average price. That flips the regime from sell rallies to buy dips is the single most important signal. 2. Stability rising to 1 or 2 out of 2. That tells me the volume profile is consolidating at a base instead of still expanding into a sell-off. Right now it's 0. We need to see it build. 3. Volume compression entering coil territory. Remember, Bitcoin is at 87% compression, coin is at 50. We need that spring to load before a sustainable move can happen. 4. Cantillon flow moving from accumulation towards early cycle of full risk on. That confirms liquidity has flowed through the full sequence and actually reached risk assets and crypto equities. None of these conditions are present today, but the CPI trajectory, the macro bonus of +2 and the accumulation regime tells me the upstream conditions are forming. This is not a question of if, it's a question of when. So here's the bottom line. Coinbase is building the infrastructure for a financial system transformation. At 14 times trailing earnings with 11 billion in cash, the valuation reflects near-term cyclical pessimism, not long-term structural reality. The bull case is real, but the Cantillon framework is ambiguous. The regime hasn't flipped. Institutions are not positioning for the transformation yet. The volume structure shows distribution, not accumulation. And coin sits at the extreme end of the flow sequence, requiring bonds, equities, and crypto to all improve before the bid reaches this name. The other day 16% rally is the first signal that upstream conditions are shifting. But one day is not a regime. The terminal will confirm when it is. So until then, regime first, volume second, and price last. That is the discipline. This is how we do elite research at Cantillon Research. If you want the full report with specific price levels and position management framework, that's available through IVT Elite Research. Link is in the description. And if you also want my institutional volume terminal, the link is also in the description. If you find this kind of analysis useful to you, hit the like, subscribe, and I'll see you in the next one. Take care and trade safe. Bye bye.